Welcome to Wall Street. It's a jungle out there. Fortunes are made and lost in the blink of an eye, but amidst the chaos, there's a rhythm, a pulse, a pattern. It's the heartbeat of the market, and it's called a trend. Understand these trends, and you unlock the secrets of the market. Ignore them, and you're just another tourist about to get eaten alive. This isn't some get-rich-quick scheme. This is about arming yourself with the knowledge to navigate the financial wilderness. We'll delve into the heart of market trends, what they are, why they matter, and how to spot them before they happen. We'll break down complex jargon into bite-sized pieces, even if you think a bull market is just a place where angry animals roam. Think of this as your survival guide. We'll explore the exhilarating highs of bull markets and the gut-wrenching lows of bear markets. We'll also uncover the secrets of sideways trends where the market seems to be taking a nap. Through real-world examples, you'll see how these trends play out in the real world, impacting everything from your retirement fund to the price of your morning coffee. Get ready to become a market insider, someone who sees the signs, understands the language, and makes informed decisions. This is your crash course in mastering market trends, your ultimate guide to not just surviving, but thriving in the financial jungle. In the stock market, knowledge is power, and understanding market trends is like having a superpower. Why? Because trends are like ocean currents. Swim with them, and you'll glide effortlessly. Swim against them, and you'll exhaust yourself just trying to stay afloat. There are three main types of market trends: bullish, bearish, and sideways. A bullish trend is like a rocket launch. Prices are soaring, optimism is high, and everyone wants a piece of the action. This is the time to buy low and sell high, riding the wave of market enthusiasm. Then there's the dreaded bear market. Think of it as a market hangover after a wild party. Prices plummet, pessimism sets in, and investors run for cover. This is where fortunes are lost, but also where savvy investors can find opportunities to buy undervalued assets. Finally, we have the sideways trend. Imagine a ship stuck in the doldrums, sails limp, no wind to speak of. Prices fluctuate within a narrow range, neither rising nor falling significantly. This can be a frustrating time for investors, but it's also a time to observe, analyze, and prepare for the next big move. Let's bring these trends to life with some real-world examples. Picture the dot-com boom of the late 1990s. The internet was the Wild West, and investors were throwing money at anything with a .com at the end of its name. This was a classic bull market fueled by speculation and the promise of unimaginable riches. But what goes up must come down. The dot-com bubble eventually burst, leading to a painful bear market in the early 2000s. Investors who had poured their life savings into overvalued tech stocks saw their portfolios vanish overnight. The party was over, and the cleanup was messy. Now, imagine a period of economic uncertainty like the aftermath of a global pandemic. Businesses are hesitant to invest, consumers are cautious with their spending, and the stock market enters a sideways trend. This is a time for patience, for waiting for clearer signals before making any major investment decisions. So, how do you, the intrepid investor, spot these trends before they become headline news? It's all about reading the signs, like a seasoned tracker in the wilderness. One key indicator is market sentiment. When investors are optimistic, the market tends to rise. When they're pessimistic, the market usually falls. Keep an eye on economic indicators like GDP growth, unemployment rates, and inflation. These are the vital signs of the economy, and they can give you valuable clues about the direction of the market. A strong economy usually translates to a bull market, while a weak economy can signal a bear market on the horizon. Pay attention to interest rates. When interest rates are low, borrowing is cheap, and businesses tend to invest more, fueling economic growth. This can lead to a bull market. Conversely, high interest rates can stifle growth and put downward pressure on the stock market. Predicting market trends is not an exact science. If it were, we'd all be millionaires by now. But by analyzing historical data, understanding economic cycles, and keeping your finger on the pulse of current events, you can make educated guesses about the future direction of the market. Remember, history doesn't repeat itself, but it often rhymes. Study past market crashes like the Great Depression or the 2008 financial crisis. Understand what caused them, how the market reacted, and what lessons can be learned. This knowledge can help you identify potential risks and avoid repeating the mistakes of the past. Don't rely solely on your gut feeling. Back up your investment decisions with solid research and analysis. Consult reputable financial news sources, read analyst reports, and consider seeking advice from a qualified financial advisor. The more informed you are, the better equipped you'll be to navigate the complexities of the market. Section 6. The Tech Bubble, a Cautionary Tale. The dot-com bubble of the late 1990s serves as a stark reminder of the dangers of irrational exuberance and speculative investing. Fueled by the rise of the internet, investors poured money into technology companies, driving stock prices to unsustainable levels. Many of these companies had no profits, no proven business models, and were based solely on hype and speculation. As the bubble grew, warning signs began to emerge. Valuations were sky high, and companies were being valued based on metrics that had no basis in reality. However, many investors, caught up in the frenzy, ignored these warning signs, believing that the party would never end. But as with all bubbles, it eventually did. When the bubble burst in early 2000, the Nasdaq Composite Index, which was heavily weighted towards technology stocks, plummeted by over 75%. Countless investors, many of whom had invested their life savings in high-flying tech stocks, were wiped out. The dot-com bubble serves as a cautionary tale about the importance of rational investing, sound fundamentals, and avoiding the allure of get-rich-quick schemes. Section 7. Riding the Waves of Change. The world is in a constant state of flux. Technological advancements, geopolitical events, and shifts in consumer behavior are just a few of the factors that can impact the market and create new trends. The rise of e-commerce, for example, has revolutionized the retail industry, creating winners and losers along the way. Similarly, the growing awareness of climate change and the shift towards renewable energy sources is creating new investment opportunities in green technologies. The ability to adapt to these changing dynamics is crucial for investors looking to stay ahead of the curve. Don't be afraid to embrace change. What worked yesterday might not work tomorrow. Stay informed about emerging trends, research new industries, and be willing to adjust your investment strategy accordingly. Remember, the only constant in the market is change, and those who can adapt will be the ones who thrive. Section 8. The Future of Trends. Predicting the future of market trends is a fool's errand. However, by examining current trends and extrapolating them into the future, we can make some educated guesses about what the future might hold. One thing is for sure, technology will continue to play a major role in shaping the market. Artificial intelligence, machine learning, and blockchain technology are just a few of the innovations that are poised to disrupt industries and create new investment opportunities. The rise of automation and the gig economy will also have a profound impact on the labor market, creating both challenges and opportunities for investors. Globalization and the interconnectedness of the global economy will continue to influence market trends. Events in one part of the world can have ripple effects across the globe, impacting everything from currency exchange rates to commodity prices. Investors who can navigate this complex web of interdependencies will be well positioned to capitalize on emerging opportunities. Section 9. The Informed Investor. Mastering market trends is not about predicting the future with perfect accuracy. It's about understanding the forces that drive the market, recognizing patterns, and making informed decisions based on available information. It's about being a student of the market, constantly learning, adapting, and evolving your investment strategy. Remember, investing is a marathon, not a sprint. There will be ups and downs, bull markets and bear markets. The key is to stay disciplined, stick to your investment plan, and avoid making emotional decisions based on short-term market fluctuations. By following the tips outlined in this essay, you can empower yourself to become a more informed, confident, and successful investor. The journey to financial freedom starts with a single step. Take that step today and start mastering the art of market trends. The future of your financial well-being depends on it.